Good evening and welcome back to Be Rich. The markets have paused from a big fall, though the last week the Dow and the Nasdaq resumed sell off. But this is an intermediate sell off. The markets could resume the rise this week. But if you ask me whether the markets have recovered, the answer is no, because there are more headwinds than tailwinds. The headwinds are many, as I have pointed out, that inflation is raging high, job markets are very tight, labor is tight. In fact, with the rising wages, it is becoming very difficult to find people to do work, and so salaries are going up, inflation is getting entrenched, and this is not a simple supply side problem. This is inflationary expectations are going up. Sales from supermarkets, from Target, from Walmart, all of it are indicating that this is a inflation is getting entrenched. Also, the crude price rise is not going to go away anytime soon. Europe has moved on sanctions to Russia, so Russian oil will become more difficult to buy. Plus, Ukraine and Russia are unable to export wheat, which means food prices will climb because they are the largest and the fifth largest supplier of food products. Sunflower oil has gone out of the market. Therefore, edible oil prices also are on the boil. So, several inflationary patterns are working together. The zero COVID policy in China has made things worse, and so supply chains also are stretched. In this scenario, earnings are expected to get weak and markets are expected to fall. The markets just pull back from the 20% mark, which is normally the mark for bear markets. A study of history will show us from 1926, the S&P 500 has had 15 bear markets, of which in 11 times there has been an intermediate pause. The intermediate pause has lasted up to 4 months, and then there is another fall. One can safely assume that there is going to be another major fall coming up, which will push you one level down. There have been 5 occasions when the bear market reached 20% and did not go down further. 2018 is one such a case. In all these cases, the markets were rescued by the Federal Reserve. The Federal Reserve ran a loose monetary policy and cut interest rates dramatically and flooded the market with liquidity, which caused asset prices to increase. However, whatever is the position today is completely different. The Fed is in no position to cut interest rates. In fact, the Fed cannot even pause. The Fed will continue to tighten. Inflation is nearly 4 times what Fed normally should tolerate. Inflation is 2%. That is the tolerance level of the Federal Reserve. The inflation is at 8.3, which is more than 4 times that. So Fed will tighten 0.55 and zero point 0.5 twice. In June and August, it is expected that the Fed will start to reduce the rate of increase after that. But that is a fond expectations. The Fed will continue to increase interest rates unless inflation shows signs of coming down. We have gone past the base effect, so you cannot blame base effects anymore. Inflation is truly and well entrenched. Most experts say inflation will drop to 4% within 1 year. If the Fed rate reaches neutral, that is 3%. However, things could get sticky there, and the Fed needs to act beyond that to bring it down to its 2%. The Fed has also started to shrink the balance sheet. The balance sheet was $1 trillion in 2008, is now $9 trillion. That means the Fed has printed 9 times money between 2008 and today, while the economy has gone up only 2.5 times. The Fed, in a measure to fight inflation, has started to roll back that excess balance sheet. How does it do it? So far, Even if it was not buying fresh bonds, bonds that were matured were being bought back by the Fed to keep the balance sheet at an even keel. Now, starting from May, the Fed has said it will allow $95 billion of bonds every month to run out. If this program continues for 1 year, the Fed would have shrunk its balance sheet by 1 trillion. All this will put enormous pressure on the market, and the market is expected to sink. As the Fed tightens, market participants are already now complaining that there will be a huge loss because of there will be a huge loss in consumer confidence. This Fed may enter the American economy may enter a recession, and if the Fed continues to tighten, the recession will be deep. Let us be rest assured that inflation has become a political issue, and therefore Jerome Powell has no option but to keep tightening even in face of recession. So whether the recession is mild or deep, it will affect consumer confidence, it will affect real earnings, it will create unemployment, and therefore this is more bad news for the market. Therefore, the market will fall further, and one can expect greater pain because the Fed is in no position to rescue the market at this point of time. This will put enormous pressure on the markets. Why have markets not fallen more than this? Institutional investors have started to correct their position. They have started to dump equity, and at every opportunity are selling. It is the retail investor who is directly invested and invested through ETFs who is not moving. He has barely flinched. Once the reality sinks into him, he will start to sink, and the S&P 500 will to start to sink with it. The recession will make things worse, so one can safely expect this ledge to be crossed and another ledge to be found. So if this 20% fall starts from here again, you could quickly see another 20% fall and the index at a 40% low from its peak. This is very painful because for nearly 2 generations, we have not seen such a major fall in the developed markets. So this could be a learning experience. So don't rush to buy stocks, wait for the right time. Thank you for watching. Be rich. If you like this content, kindly press the subscribe button and turn on the bell notification. If you do not turn on the bell notification, you will be not notified every time we put out a video. Once again, I thank you for your support to Be Rich. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.